when you look at the company like Alphabet, the parent of Google, you see billions of dollars flowing in every month. Last year alone, they brought in over 400 billion. But here's a secret. In a world of finance, it's not about how much you make. It's about how much you keep. Today, we are breaking down the single most important metric for understanding a company's DNA, gross profit margin. We are going to use Google as our case study to see if this tech giant is actually as efficient as its stock price suggests. Before we dive into the numbers, let's simplify. If you sell a cup of lemonade for $2 over here, $2 for the cup, and the lemon and sugar cost you 50 cents, your gross profit is $1.50. That's a 75% margin. Simple, right? In the big leagues, we call those lemon costs, COGS, cost of goods sold. For Google, COGS isn't fruit. It's the electricity to run servers, the licensing fee for YouTube creators like me, and the rent they pay to Apple to be the default search engine on your iPhone, if you have one. Everything else, your research and development, your marketing, your office snacks, doesn't count yet. Gross profit margin is just revenue minus the direct cost of the product. Now let's look at the actual 2025 numbers. Alphabet pulled in 402.8 billion in revenue right here. Their direct costs to keep light on were 162.5 billion. So do the math and you get a gross profit of 240.3 billion. That's a 59.7 margin. Why does that number matter to you as an investor? Because it tells you Google has massive pricing power. For every dollar they earn, nearly 60 cents stay in their pockets to fund moonshots like Waymo or to build the next generation of AI, which I really like Gemini. Compare that to a retail giant like Walmart, which often operates on 25% gross margin. Google isn't just selling search. They are selling high efficiency digital real estate. The real magic isn't just the number itself, it's a trend. In 2025, Google margin actually ticked up. That's rare for a company this big size. It suggests they are getting better at managing their data centers or that their cloud business is finally hitting a stride. But keep an eye on this. As Google pivots harder into AI, those server costs, the GPUs, the power they consume, could start eating into that margin. If you see this number starts to slide toward like 50%, it is a sign that the cost of being Google is getting more expensive. Now to recap, gross profit margin is the first filter every investor should use. It tells you if a business has a juice or is just treading the water. If you want to see how this compares to net profit, the money that it actually goes to the shareholders, let me know in comments below. I'll be happy to make that video. And don't forget to like, subscribe, and I'll see you in the next one. Thank you. Bye.